welcome to the Explainer. So the market's been on a tear, right? But what if the story everyone's telling about why it's rallying is, well, wrong? Today, we're going to pull back the curtain and look at the hidden force that could really change the game for all of us.
All right, let's just jump right in. This is the big question, the paradox that's got everyone scratching their heads. People are still nervous. You can feel it. So why on earth does the market keep marching higher? Let's figure it out.
To really get to the bottom of this, we first have to talk about psychology. Because the most important shift we've seen lately isn't really about charts or data points. It's about what's going on in investors' minds. So get this. We haven't flipped from fear to greed, which is what you'd normally expect in a rally. Nope. The change is way more subtle. We've gone from extreme fear to just fear. And I know that doesn't sound like a big leap, but trust me, in the world of markets, it's absolutely massive. And this brings us to this really cool concept in investing, right? It's called the theory of contrary opinion. Basically, as long as people are still a little scared, it means the market probably hasn't hit its top. That fear is actually fuel. It means there's still money sitting on the sidelines waiting to jump in. And that's what lets the market climb that classic wall of worry. Okay, but look, this isn't just a bunch of fluffy talk about feelings. Let's get into the hard numbers, because when you look at the data, it's telling a pretty powerful story. This rally has some serious legs. First up, let's talk about high beta stocks. Beta is just a fancy word for how much a stock swings up and down compared to the rest of the market. So, high beta stocks, they're the high flyers, the riskier plays. When investors are feeling bold, these are the stocks they pile into. They're like a perfect gauge for the market's risk appetite. And would you look at that? The main ETF that tracks these stocks just blasted to a new all-time high. I mean, that's not cautious optimism. That is a full-throated roar of confidence from investors. They are all in on this rally's strength. And hey, this isn't just happening in the wilder corners of the market. We're seeing the exact same confidence in the tech world. The Nasdaq 100, home to all the tech giants, is flashing some seriously bullish signs too. Now, for you chart watchers out there, this is a big one. The index just broke through a key downward trend line. Think of it like a ceiling that's been holding prices down for weeks. Smashing through that ceiling, that's a textbook signal that the old downtrend is dead and a new move up could be starting. All right, I know what you're thinking. I hear it all the time. Yeah, but this rally isn't healthy. It's just a few giant tech stocks doing all the work. And you know what? That's a totally fair point to make. But is it still true? Let's check the data. To really put that idea to the test, we've got to look beyond the big names. Let's pull up the Russell 2000. This index is a huge basket of 2,000 smaller companies, the small caps. It gives us a much better picture of the whole market. If the rally really was just a few big stocks, this is where we'd see the weakness. And, well, look at that. That whole argument about poor market breadths, it's starting to look pretty shaky. The small caps have also broken their downtrend. Now they're kind of chilling out, moving sideways in what chartists call a consolidation. It's like the market's taking a quick breather, catching its breath before the next leg up. The party is definitely getting bigger. So, okay, we've got a strong rally, it's getting broader, and because of all this, a really popular story has taken hold. A narrative about what's going to pour gasoline on this fire. And that story has one main character, the Federal Reserve. Yeah, the story you hear pretty much everywhere goes like this. The Fed is about to flip the switch, print a ton of money, slash interest rates, and that's going to be the rocket fuel that sends stocks to the moon. It sounds good, right? But what if that entire story is a myth? To get to the real story, the one that isn't being told, you have to understand the difference between two huge players in Washington. They sound similar, but they're not. We're talking about the Federal Reserve and the U.S. Treasury. They both play with trillions, but where that money goes, totally different. Okay, so here's the absolute key difference you need to get. When the Fed adds liquidity, that money mostly stays trapped in the financial system. It juices up Wall Street, pumping up stock and bond prices. But when the Treasury spends money, that's cash that goes straight to Main Street. It goes into the real economy, into people's pockets. And yeah, that helps the economy. But it also has a major side effect, inflation. So the real picture is way more complicated than Fed prints money. The Fed is probably going to be super careful. They're terrified of sparking inflation again, so they'll likely cut rates just a little and add only enough cash to keep the pipes from clogging. The Treasury, on the other hand, they've got a big pile of cash they're ready to spend, and that's the money that's going to hit the real economy. And check out this clever move the Treasury is planning. It's kind of like a financial magic trick. Step 1, they spend a bunch of money, which gets the economy humming and pushes prices up. That's inflation. Step 2, at the exact same time, they sell Treasury bills to soak up the exact same amount of cash they just spent. So what's the end result? You get the inflationary push from the spending, but without flooding the markets with new money. Pretty slick, right? Okay, so let's pause and connect the dots here. What does this all actually mean for us? The market has been betting the house on a story about Fed liquidity. But the real story, it seems to be about Treasury spending and, you guessed it, inflation. So how does that completely change the forecast? Well, the thinking goes like this. This rally has room to run probably through the rest of this year, powered by all that real economic juice from the Treasury. But there's a catch. Sometime early next year, the market might suddenly slam on the brakes. That's when the narrative could flip from, hey, growth is great, to, uh-oh, where did all this inflation come from? And this isn't just some wild theory. The smart money in the bond market is already making moves. We're seeing a huge spike in people betting against long-term bonds. And what is that? That's a direct bet that inflation and interest rates are headed higher. The bond market is already sniffing this out. And this feeling of confidence, this bullishness, isn't just confined to stocks and bonds. We're even seeing signs of it over in the crypto space. And what's interesting is it seems to be based on some real underlying value, not just pure speculation. Just like a Bitcoin, for example, the average cost just to mine a single Bitcoin is now around $75,000. That creates a kind of natural price floor, way below where it's trading now. It gives investors a tangible number to anchor to. And when you see even the most speculative assets being analyzed like this, based on their fundamental costs, that tells you something about the broader confidence in the market. So there it is. That's the hidden story. The market rally is real, but the reason why might be completely wrong. It's not a story about Fed liquidity. It's a story about Treasury spending and inflation. The engine's still humming, but the fuel is changing right under our noses. And that leaves us with one final critical question. Is your portfolio ready for the moment the market finally figures this out?